Hey guys, this is Matt with the Bullish Bears team. So let's talk about the Iron Condor. Now I know that the name can kind of sound intimidating, but once we get into it, I think you guys will realize that all it is a combination of two strategies that we talked about previously. So what we'll do is we'll go above the market and we'll sell a bear call spread while simultaneously going below the market and selling a bull put spread. And those two strategies together form the Iron Condor. And the Iron Condor is a great neutral strategy where we want the stock to stay range bound, really allow theta to work on the position, and hopefully getting a decrease in implied volatility. So here we are in Thinkorswim, and we're looking at Tesla. You can see we've had a recent sell-off, and it's kind of in a consolidation period right here. And you can see implied volatility is high, so just for the sake of this video, let's say that we want to sell an Iron Condor on Tesla. So again, we'll come above the market, we'll sell a bear call spread, while at the same time going below the market and selling a bull put spread. And what we want to happen is to give Tesla all this room right here to do whatever it wants to do. We really don't care. All the way heading into expiration, allowing theta to work on the position. And if we get a decrease in implied volatility, that will also help us reach our profit potential. So here we are in the options chain of Tesla. And if you'll recall, in the bull put spread and the bear call spread scenario, we would find our probability in the money of 30%, which also means that Tesla had a 70% chance of not even getting to that strike. So that's how we construct our 70% probability of profit trade. So here, this is one trade. And instead of the 30, you want to break that down into two increments of 15%. And that's how we'll get our 70% probability of profit trade on an Iron Condor. So here you go to the put side, find probability in the money, find your 15%. In this case, it's the 185. You'll right click, sell, Iron Condor. And in our order form, you'll see here that on the put side, we're going to sell the 185, and we're also going to purchase the 180. And that forms the lower bracket of our Iron Condor. And that's also what our bull put spread is. So then we go to the call side. We find our probability in the money, find our 15% roughly, and that's going to be the 315 strike. And you'll see that Thinkorswim defaults to the next strike up from your first entry, so we'll have to edit that. So we're going to sell the 315 strike, and we're also going to purchase the 320 strike. So this forms our Iron Condor, guys. And you'll see we're taking in a net premium of $1.14. So let's talk about some of the math and how Thinkorswim calculates this for us. Our max profit is going to be our total premium received. In this case, we're taking in $1.14, so the most we can make on this trade is $114. The max loss is going to be your strike width minus your entry price. And this is another good time to mention, try to keep your strike widths the same amount on either side of this Iron Condor. So here you see our strike width is $5. If you subtract the 114 from that, you'll see that the max that you can lose on this trade is $386. And that's also going to be roughly what it costs you to hold this position. But once they calculate your trade fees and they subtract that from the 114, they take the 108 actually is what they take from your strike width. And so that's what it's going to cost you to hold that position. So your break evens, you're going to have two of them since this is two spreads sold on either side of the market. And so your bull put side is going to be your short strike, which is the strike that we sold, minus your entry price. So here you see we sold the 185. If you subtract $1.14 from that, you'll get the 183.86. And on the bear call side, you'll have your short call strike, the one that we sell, plus your entry price, which is the premium we received. So we sold the 315, and if you add the 114 to that, you'll get the 316.14. So that, guys, that right there, so long as Tesla trades in between 183.86 and 316.14, we're going to make money on this trade. So here's a close-up image of it, and you can see it has a lot of room for Tesla to move right here heading into expiration, allowing theta to work on the position and hopefully getting a decrease in implied volatility. And again, time decay is in our favor. And when you sell options, you want to enter this position when implied volatility is high. And if you get a decrease in implied volatility, that will also help this position out. You want to sell this strategy 30 to 60 days out. And just like in the strategies before, I recommend that you take in roughly between 20 to 33% of your strike width. If you have a $5 strike width, 20% of that will be $1. So you want to at least be taking in $1 of premium to justify the risk that you're taking on. The higher the premium, the better. And I personally recommend you closing this position at 50% of your potential of profit. So in this case, you can see the most we can make is $114. So what I would take in, I would close the position at $57. But again, guys, that's totally up to you. You can work that however you want to work it. It really doesn't matter. Excuse me. One other point that I want to cover here is if you're actually a little bit directionally biased on this trade, you can actually skew this. So if you think that Tesla's formed support right here, and you just want a wide, broad range for this stock to move heading into expiration, you can come in as close as you want. I mean, you can make your iron condor that large, and you can still do it with a 70% probability of profit. So whatever your probability of in the money is here, if it's 20% here, you'll want to do 10% on the call side. If you're 20% on the call side, you'll want to do 10% here. So you can skew this trade however you want to. It's up to you. So until the next video, guys, thanks. Please leave all your comments and questions below. Thank you.